Great. Well, welcome everybody. Welcome to the Future of Packaging Conference. Very much appreciate everyone's flexibility for accommodating our online format this year. I can't tell you how happy I am to see so many familiar names who are going to be attending this conference. For those of you who are new to the conference, a big welcome to you. We're very happy that you're here. I think probably many of you have seen that this is an annual conference that we at L.E.K. Consulting conduct with our friends at Smithers. We're usually doing this in person in the great city of Chicago, but for obvious reasons, we're doing it in a virtual world nowadays. So thank you very much, everyone, for attending. I'm Thilo Henkes. I'm a partner and managing director at L.E.K. Consulting. I lead L.E.K. Consulting's paper and packaging practice. And this is day one of the 2021 Conference on the Future of Packaging. Before we begin with today's session, I'd like to just share a couple of housekeeping items for all of you. The first one is, please feel free to join us in conversation. We will be having a panel after a keynote address here, and there will be a time at the end of the panel for questions. Please submit your questions via the chat tool on your screen. Don't know if everybody's familiar with Zoom, but if you scroll down to the bottom of your screen, you'll see that there is an icon that says chat. You can submit questions through that chat tool. We also encourage you to connect with fellow attendees using that very same chat feature. You can schedule meetings. We'll see that there's some various lounges that are actually also here in the virtual world where you can continue conversations even after the panel event. If you need any assistance, you can absolutely email either Brittany Norton or Megan DeNovellis, both of whom I think probably everybody, whether you're a speaker or an attendee, you've gotten emails from them. So feel free to email either of them if you have any issues. Also just like to note that all 4 sessions are going to be recorded and will be shared with registrants post the event. As I mentioned, there are 4 of these presentations. Let me just quickly go through that timetable for those 4. Today, of course, we were going to be talking about the M&A environment. Panel number 2, which will be this coming Thursday, April 29th, at the very same time as this one, we'll be talking with panelists regarding sustainability goals, and in particular, sustainability goals from brand owners' perspectives. On Tuesday, May 4th is our third panel, and that will be looking at recycling and sustainability, if you will, from a converter's perspective. So that panel is entitled Recycling: How Are Converters Satisfying Brand Owner Sustainability Demands? And the final panel will be on Thursday, May 6th, and that will be a panel focused on innovation in packaging opportunities in the packaging world. So those are 4 panels that we will be conducting, all brought to you by L.E.K. Consulting and Smithers. We hope that you will join us for all 4 of those panels. Now, for today's agenda, we're kicking things off these 4 sessions with a focus on M&A in the packaging world. We're going to begin with a keynote address, and then we'll launch into a panel discussion and follow that up with opportunity for question and answer from the audience. Let me say a few words about our keynote speaker. Mike Palm is a senior managing director at Evercore's corporate advisory business. Mike provides strategic and financial advice to industrial companies with a focus on packaging, paper, and forest products. Before joining Evercore, Mike was the global head of paper, forest products, and packaging at Barclays. All told, Mike has more than 20 years of corporate and investment banking experience in the paper, forest products, and packaging sectors, though when you look at him, you'd never guess he had that many years of experience. Mike is going to talk to us about trends that he's seeing in the M&A markets in the packaging sector. He's going to walk us through a couple of metrics, longitudinal look at some metrics, and he's going to talk about how some current trends, issues like sustainability and COVID have impacted the M&A environment. So with that, Mike, over to you. Thanks very much.
Well, thanks, Thilo. And I'm going to put that said presentation here up on the screen for everybody. Okay. Well, good morning, everyone, and hopefully you can hear me fine. Delighted to kick off this first panel discussion. And my job's easy. I've got no interruptions, 15 minutes. In fact, I'm going to start my timer here to really set the table for the distinguished panel that is in behind me here to answer some of the questions around where packaging M&A is heading. So I've got a few slides really to whet the appetite and maybe cause some or give some thought to some questions that may be addressed to the panel that follows. So I will start with that longitudinal history of packaging. And there is a tremendous amount of data on this page, but let me just give you some highlights. This market for packaging M&A remains incredibly vibrant. And I'd point you to the number of transactions across that timeline. And you really see the velocity of activity pick up, really since the wake of the financial crisis, 15 through to year to date. And if you look at even 2020, and I should point out these transactions are over 150 million in size. There's been a tremendous amount of activity. You go back in the early days of COVID, I thought we're going to hit pause, and we did for a short period of time, but 23 transactions in the packaging space got announced in 2020, which is remarkable. And you can see the valuation, although I point out that valuation is a little bit skewed. I wouldn't read too much into that 14 and 12. There are a couple of transactions in there that are skewing that data. But you can certainly see that the elevated valuations continue in packaging. The spread between private transactions and public valuations continues, and I'll talk about that in a minute. And then the importance of private equity as both seller, but on this page, we're highlighting as buyer. You can see that in these packaging transactions over time, private equity remains the buyer of choice, where since 15, it's on the low end, nearly half, and then 2/3 on the upper end in terms of private equity being the buyer of packaging assets. And we'll talk a little bit about why packaging is viewed as such an attractive space by private equity. A few reasons at the bottom of this page as to why the multiples have been what they are and why the activity has been so frequent. We've had and continue to have incredibly accommodating, aggressive financing markets, and you can see that continuing today with the stimulus. In fact, for best in breed packaging stories, you've got portability out there. So that certainly is another tool in the toolbox to support very aggressive sale processes. And you can talk to the panelists representing private equity. There's just a lot of dry powder that sits out there. And I mentioned earlier, there was plenty of activity that was completed in 2020. But for other sectors, there was a pause. And you didn't see that much here in packaging, but there is some pent up demand due to that pause due to COVID. One of the things that I think we'd all agree on is there are more eyeballs on the space. When I first started covering packaging, there was that list that was reasonably short of private equity firms that really focused on the space. Today, it's a remarkably long list. And when you look at some of the recent activity and you see the buyers, you see that this space is one that is followed by an increasing number of interested buyers, and that certainly has elevated or had an impact on the degree of interest and multiples that have been paid in the space. I think one of the biggest drivers is the next driver. When you look at packaging versus other sectors for private equity in particular to invest in, the downside here is incredibly well protected for the most part. And I do think, particularly when we're getting long in the tooth in the expansion, now COVID has reset that to a degree, there were certainly buyers that were interested in paying up for that downside protection at the expense of some upside trade-off. And then the other thing, which leads into the next page here, in this data, you're going to find a number of what I call serially rented true winners in the packaging space, names that have made money for all private equity owners. And that thematically we expect to continue. And that's sort of a good kicking off point to what are those characteristics that make up these, serially rented top quartile assets. Well, at the start, you have to have some table stake, check the box items, great, deep, proven management team, solid absolute and relative market share positions in your businesses, and really strong free cash flow profiles, which are typical for best-in-class packaging names. But the differentiators that really, move something from trading at 10 or 11 times to 13 to 14 times are the things that are some of them listed here in the differentiators box, what I call a right to win or a demonstrated moat, where the business is uniquely positioned and protected. So I think of names like Charter Next Generation in that category, or Pregis, or Mike Denvir can speak to Promoc. These are businesses that are unique in what they do, or Berlin Packaging. Organic growth. It's the most important indicator for top quartile multiple assets. And that organic growth can be market growth and also share gains. And you see that in some of the areas that are hot right now, like e-commerce or cold chain, as examples where you see some really outsized organic growth. And then importantly, here's another Promoc example. If you've got an actionable M&A pipeline, not only actionable, but you've been able to show over time that you've been able to find, integrate, and capture the value, buyers are going to lean into that, particularly in markets like today where they're clearly seller friendly for some of the attributes we talked about earlier. So at the bottom of this page, I've just looked at one. There's several of these names. You can see some of the other candidates off to the right. You look at the serial winners. Tricor is a great example. Berlin, Promoc, ProAmpac, Waddington. Look at this EBITDA growth, organic and M&A, and then the multiple expansion that's gone along with it. And the only thing I'd say about the ability to continue this is when you get to a certain size, and let's call that, 300 to 400 million of EBITDA, there are plenty of buyers even at that size in private equity land. But when those buyers come into an asset of that size, they have to think about their own exit. And if you're thinking about doubling EBITDA from that size, well, then you're going to get into a situation where you have to lean a little bit more on something other than a private equity exit, i.e. an IPO or some other exit path. And that does, for assets that are of that scale, have an impact potentially on value for that entry point. So what I've done on this page, and there's a lot of data on this page, and these are they're not in chronological order to protect the innocent here. This is some rounded data across a number of those serial winners. And this is a scorecard that we use at Evercore. It's no rocket science to it, but one of the things, or the attributes, the financial metrics we look at, first and foremost, table stakes, which is free cash flow conversion. And then we look at growth, both organic and also, historic. So you capture some of the M&A growth. And then we also look at capital intensity, and we certainly look at that capital intensity and factor out maintenance from true growth. True growth is important, not growth to retain customers, but growth that actually creates new customers and new revenue sources. And then we score on acquisition history and also the strength of the strategic bid for a particular process and the leverage that was achieved. And if you look across this page, we've highlighted one that we sold back in 19. People can probably guess what that is. It's in the protective space. But you can see that you see outsized EBITDA multiples and importantly, a multiple that doesn't get enough headline time, EBITDA less CapEx. So those are sort of the attributes that we track at Evercore, and I'm sure most people track when they look at what distinguishes a 12, a 13, a 14 from a 10. And I like to say, and people have heard me say this, I'm sure others say it as well, 10 is the new 8. Used to be that 8 was the sort of median packaging type company, and that certainly has changed for some of the reasons we talked about earlier. One topic I mentioned that is a key driver for valuation is growth. And one of the most remarkable growth stories in packaging, and you wouldn't have thought this just a few years ago. In fact, if you look at Ball Corporation in late 2018 and you look at their investor presentation, the outlook for beverage cans was globally 2.3% growth, and North America was forecast to decline. And then all of a sudden, people like Thilo and others started, drinking their Trulies and all those flavored alcoholic beverages and cans, and sustainability became more than just a couple pages in a management presentation. And you can see what's happened to the growth rates in beverage cans globally and in North America. And what does that mean for Ball? Well, it meant a doubling in their stock price. And it also meant that their multiple jumped from 12.3 on a 1-year forward basis to 19.4, which is pretty remarkable. And the capital intensity in terms of getting capacity in the market across Ball, Crown, Ardagh is there. It's a remarkable story, but it's had transformational impact, not just in the form of Ball stock price, but for the industry. And we've listed at the bottom of page 4 some of the transactions that were driven by growth. And and these happened, all recently. Apollo, buying a minority stake at a very high valuation in the AB InBev. Ardagh, the second SPAC in the packaging space. SPACs are the hot topic of the day, and Ardagh, I think, was trading around eight times. Yet they had, $600 million of EBITDA in the beverage can business that they were able to SPAC at 13 times forward EBITDA, more like 15.5 times 2020. And they were able to position that at a discount to where Ball trades. So an opportunistic value capture opportunity for Ardagh. And then most recently, a transaction that we announced just a couple of weeks ago, Crown sold its European tinplate business. And one of the reasons to sell that business, it was a great multiple, but dilutive to where Crown trades, was so that Crown could look more like a Ball in terms of its contribution for BevCan. So when you have growth, whether it's BevCan or other areas of packaging, that tends to really create opportunity and certainly results in multiples that you haven't seen before in the packaging space. So last topic before I turn it over to the panel. A lot of people ask the question, okay, where are we heading? And before we talk about, and the panel talks about where we're heading, talk about what impact COVID has had on the packaging market and the broader M&A market. First thing I'd say is, and we've seen this firsthand. These formats takes a little time, which is why we're on 30 minutes before the launch of this, to get oriented to the different formats that are out there, but electronic management meetings work, and all parties have absolutely adapted to the technology. And I think as a result, they're shorter, and you don't have the travel involved and the logistics that go with it. So it's been successful, and more successful than I thought. And think about site visits. We were able in our process, and I'd encourage you to ask Colin on the panel, you can get a lot of the physical diligence done virtually. Now, buyers are still going to want to kick some tires, but I've been impressed with the virtual impact and just knocking down some of the diligence that would otherwise be more time intensive. Now, the downside to that is it is depersonalized and sterile, and there are limited opportunities for the typical breaking of bread. And there is an offset to that, though, I'd say. And thinking about the Crown process that we just went through, which would have required me to make several trips overseas, and it didn't. And I could say, given what I know about my lack of discipline, I'm pretty confident that I was able to keep 7 to 10 pounds off this frame based on the ability to do a lot of things virtually. COVID-19 adjustments, hot topic. I asked the panel about this. A lot of creativity. It's a seller's market. I do think people are getting credit. And the question is, okay, is it a one-time bump, or is this more transitory in nature? And we've got consumer buying habits that have changed, not just for this COVID period, but for a longer period. And that is something that gets debated across each and every process. I do think in the package space in particular, you're seeing sellers put money into areas where they perceive the consumer expectations, behavioral expectations, to be more have more longevity. And we mentioned putting in new capacity for wipes as an example. Couple additional things I'd point out, and this is a good one to ask Eric or Mike on the panel. I do think private equity is picking their spots more and more, and I think COVID has had an impact on that. I do think that when they pick their spots, they're getting very aggressive, and they're not going to get the business at a lower price in this market. The highest price is going to win, but people are being aggressive when it comes to certainty and timing, and really pushing where they have an angle. Prior experience around this particular asset or a related asset, or a dry hole that was dug, or a management team that gives them a leg up. So I do think private equity firms are certainly being selective, and when they are selective, being aggressive. And then the last thing we have on the page here is sustainability. And I mentioned earlier that this used to be a 1 to 2 page argument. You made the argument that you can make, whether you're in plastic, rigid plastic, flexibles, metal. You make that argument and then you move on. I think that's fundamentally changed. I think sustainability today is, in some cases, it's binary. There are some buyers that are going to look at something and they're going to say, not going to touch it. So I think sustainability is going to be increasingly important. And you're going to see some crazy stuff as it relates to sustainability. I think there are some new materials out there. There are companies that are on that. They're focused on that nexus between e-commerce, a sustainable solution, cold chain. You're going to see some crazy valuations come out of new products that are in those categories. And then I guess the last thing I'd say that is a trend that's well underway, and this goes back to the page on the serial winners in private equity. I think private equity firms that have these winners in their portfolio are going to increasingly look for creative ways to keep them. And whether that means fund-to-fund transfers, bringing in a minority partner, serial debt recaps, equity recaps, you name it. I do think when someone acknowledges that, hey, this is a proven winner for a much longer period than my initial hold period, there's a likelihood that you're going to see these investments retained in private equity portfolios for a longer period of time. So those are the pages I had prepared. I'm not sure. In fact, I know I didn't answer where is it headed in terms of packaging M&A, but I think I've at least given the group some data, some thoughts, so that you can convert that into some challenging questions for the panel. So thank you, Thilo. I'll turn it back to you.
Thanks very much, Mike. Appreciate those thoughts. Very, very helpful. I'll ask all the panelists to turn on their videos. I'll just do a quick introduction here. Well, I think as Mike has very clearly shown, hey, packaging has continued to be a highly active sector on the M&A side, driven not only by corporates, but also private equity firms, family offices, as Mike mentioned, SPACs, and sovereign wealth fund interest has really continued to fuel the market. And while we certainly saw, I think last year, a number of deals were pulled in the depths of the pandemic, as Mike pointed out. Boy, by May 2020, the deal market was back, and I think Mike said 23 odd deals were done, throughout the year. And that really, I think, is an indication of how incredibly resilient and low beta, quite frankly, the packaging sector is. And as Mike also pointed out, boy, trading multiples have narrowed between public and private assets, and boy, the markets are at peaks when it comes to some of those trading multiples. On this panel, we're going to hear from corporate M&A, private equity, and banker panelists on how the packaging M&A environment is changing and how to win. So with that, I would like to ask each of the panelists to take a couple of minutes to introduce themselves and their company and your experience in the packaging sector. Colin, let's start with you, and then we'll go to Mike, Suj, and then Eric.
Sure. Thanks, Thilo. Colin Convey. I work at Goldman Sachs. I've been here a little more than a decade, partner at the firm, and I lead our paper and packaging advisory business globally, and have the good pleasure of actually spending time in our travels with the panelists here. So should be a fun discussion today.
Excellent. Mike?
Yes, my name is Mike Denvir, partner at the Jordan Company. I've been there over 20 years. I think that's relevant to today's conversation, thinking about the evolution of this sector, particularly over that period of time. We've had, I think another topic here is how broadly packaging the industry has spread into other areas. So, the companies we've owned, Promoc, Transcendia, Anchor Packaging, we're about to close on Spartech. Some of those are the picks and shovels, some of those are the equipment, and some of those are the actual product. And that's, I think, is Mike was talking about dry powder and more coverage, more people focus. Some of this, it's actually expanded the breadth, but looking forward to today's conversation.
Excellent. Suj?
Hello all. My name is Suj Mehta. I lead global M&A efforts for Tekni-Plex. I've been at the company for about 12 years. I'm a lawyer by trade, try not to hold that against me, though some of my fellow panelists do hold that against me, so it's all right. So Tekni-Plex. Tekni is a global manufacturer of product solutions for healthcare and consumer products segments. We use deep material science expertise to deliver those solutions to our customers. We operate 35 plants across 10 countries and recently have topped about $1 billion in revenue. Many of you may know we're a portfolio company at Genstar Capital, which is based out of San Francisco. We have been highly acquisitive, having completed about 14 acquisitions over the course of the past 5 or so odd years, 8 of which under Genstar's ownership. So effectively, we've doubled the size of our company, call it in our recent history, tripled EBITDA over the years. So it's been quite a story, quite a ride. And really looking forward to the conversation, and it's a great panel. There are no coincidences. This panel was put together. It's a conspiracy by Thilo and L.E.K. around the hopes that you put these guys together in a room, there's going to be a deal that's going to happen somewhere at some point in time. So we got banker advisors, we got private equity guys, we got all kinds of stuff. So fireworks will come our way. Thanks for having us.
Excellent. Excellent. Thanks, Suj. Eric, over to you.
I think Suj is about to make an offer for one of Mike's companies. So
check your email, Eric. Check your email.
Yeah, refresh. So Eric Kanter, been with Morgan Stanley for 17 years, been in private equity for about 20. First got my start working for a very wealthy family, the Ryan family of Aon fame in Chicago in the late 1990s. I head up industrials for Morgan Stanley Capital Partners. We're a $2 billion middle market private equity fund. Industrials for us means industrial tech, industrial environmental services, and packaging. Packaging is probably our strongest power alley in industrials, having made 3 investments. In reverse order, invested in December in a business called AWT Labels and Packaging, a highly differentiated label printer and converter focusing on healthcare and consumer and personal care. Invested in 2018 in a business called Comar, which is a healthcare rigid packaging business that we've expanded through significant organic investments. And the strategy there is to move the pie chart more towards healthcare and move more up market. And then lastly, PPC Flexible Packaging, which is as the name suggests, flexible packaging platform focused on short and medium run in higher growth end markets. So appreciate everybody joining today, and look forward to a interesting discussion.
Excellent. Thank you very much to all of our panelists. Great to have you all here. And yeah, we'll see if we can create some fireworks, as Sue suggested. The first set of questions I'll ask, I'll point it to a particular panelist. Once that panelist has opined on the question, everybody, you don't have to, but everybody is welcome to provide their 2 cents on the question as well. So for the first question, Colin, we'll send this your way. As Mike Palm has pointed out in his keynote address, boy, multiples for packaging assets are at new highs. So fundamentally, the question here is, do fundamentals support these multiples? As Mike said, is 10, quite frankly, I think I saw on his page, it's more like 11 or 12. Is 11 or 12 the new 8, right? 8's what we were seeing back in the 2004 timeframe. We're seeing, 10s, 11, 12s nowadays. How do fundamentals support these multiples, and how are you advising clients in the current market, Colin?
Yeah, and look, I think as much as I would like to disagree with Mike, I think he was spot on in all the key points that he made. So I won't belabor the answer to this and repeat a lot of it. But I mean, fundamentally, we're just to start with the macro. We're living in a world where the cost and availability of capital is starkly different than any periods of time that we've seen previously. And so the pure math of the relative cost of capital has certainly worked to drive multiples north of that, independent of sort of company specific performance, the availability and amount of private capital on the equity side, not just private equity, but the level of sophistication that a number of family offices have gotten to, interest in the sector from sovereign wealth, from pension money. There's just seemingly endless pools of capital that are keenly focused on the space. And it is, as just proven, it's the vast majority of companies at a minimum are very resilient, and most are, quasi-recession resistant, and have proven that profile is very attractive. When you bought two companies for 9 times 5 years ago, and one of them you needed rescue financing for last year, and the other one you barely had to worry about. I mean, all of my colleagues in industrials here were spending their April, May, June timeframe of last year doing rescue financings, and we sort of had almost none of that activity. And so it's been a great validation, sort of the COVID period. I also do think, taking a step back from that, the business profile, both sort of margins and cash flow, and just the professionalization of some of these companies, has, you have better companies. If you look a decade ago at the margins of even the public companies, were well below where they are today. And so just fundamentally, I think the level of sophistication of management in the sector has improved, and business profiles have improved and have merited higher valuations. And two other points I think that Mike made that were sort of spot on. But one, I'm not sure I completely understand. But the public company multiples have sort of re-rated back to where they were pre-COVID levels, and private market multiples, as established, have continued to climb. I'm not sure. I'm a little bit sort of frustrated, and it's a bit confounding that the public companies haven't been better rewarded by the public markets. And that's a whole nother topic. But I think rightly so that the private market multiples, you are going to see continue to creep up, particularly for the good names. And the last thing I'll say that Mike touched on at the very end there, which is it's going to be interesting to see. But you are seeing, as people like Mike and Eric think about where to put money to work, it's getting harder, and it's getting more competitive. And so if you have a really good business that maybe is the multiple has crept up, but you'd rather keep exposure to that business than have to go find an entirely new place to put capital. So you see things like the Pritzker's doing an equity recap of ProAmpac, or Lowe's retaining a majority stake but bringing in new equity capital into Altium, or AEA retaining a big stake in Tricor. I think you're going to see that theme where the sort of the 100% sale. You're going to see other sort of derivatives of that become a little bit more the norm going forward.
That's great, Colin. And any other thoughts? Other folks have thoughts here on, I think, very interesting point, just regarding what you're saying there, Colin, about the publicly traded assets, and they don't seem to have been rewarded by the market as significantly as, say, privately held assets. And so you've seen that spread continue to widen. Any other thoughts from panelists on that?
Well, I'll jump in here. I think, if you go back 20 years ago, we were all complaining that valuations were too high back then as well. So I wish I had my time machine and I can go back and buy everything in sight, especially in this category. So I think in addition to just the flood of capital that's come in, I also think it's also because we've seen valuations increase everywhere across industrial, right? But I think packaging probably has had a greater lift. And I think that's really the market being super efficient, and so many people focused on where they can, really make money. And, you think about playing in the middle market and private equity, there's no real way to play a consumer staples play like you can in the public markets, right? You have to pick a brand, and that's going to be more of a growth equity type play. So this is, proven out to be the way to get that kind of safety exposure. And, I think, Tekni-Plex is a great example. Eric's got plenty of portfolio companies. If you can get that stability, but you also have that buy and build platform where you can do accretive acquisitions from the get, but also enhancing the business over time and making it more attractive. I mean, that's kind of where the magic's been. And, we could say multiples are too high, but people are making money. And I could say why, and people love to give can you believe what they paid for that? And, then the guy makes 3.5 times their money, and, everybody else complains. So it's been pretty interesting, but I think this whole efficient market thing is really honed in. And I think there was a gap there, to be honest, with packaging when people didn't really get it at the beginning of of this cycle.
That's great. Helpful. Mike, let's continue with you. I've got a next question here. Another one of those themes that Mike Palm brought up was just this past year, the dislocation, if you will, caused by the pandemic. Pandemic caused some short-term changes in certain categories of packaging. For example, cold cup demand, suddenly went soft. People were still going to takeouts, but people weren't, getting their takeout cold drink from the McDonald's because they were bringing the food back home. But it also created some step changes in positive demand. For example, just, the impact of e-commerce. We saw this massive step change in growth in e-commerce and the impact that has had on things like canisters, films going into disinfecting wipes, right? Amazing demand. So the fundamental question here is, as you think about the longer term impact of the pandemic on in the packaging sector, how do you assess some of these step changes, either positive or negative, in a business? How do you think about that long-term value impact on businesses?
Yeah, and I think it's good to delineate between, some of these short-term trends that we're seeing, and those are more valuation related, COVID bump, COVID positive, COVID minus, and how do we get our arms around LTM, and do we look at 2019? But when you take a big, step back and look at greater themes, there's obviously going to be a push towards more hygiene and cleanliness. But I think for the most part, and I'll try not to be just too specific to the things I'm invested in, but if you really think about it, we talk about this across the board. We've seen a lot of acceleration of trends that were already taking place, and it's just kind of fast forwarded things that we were already participating in and investing in already. So, there's plenty of examples of that in, protective packaging, e-commerce delivery, the way that things are coming to your door are going to have been changing from, the peanuts in the old days to 3 iterations since then. One probably near and dear for me is, anchor packaging makes takeout containers, right? So that was a theme that we kind of were investing in as a starting point. We saw the move away from eating in restaurants to people taking out, people cooking less, but still wanting that quality food. So we've seen great demand in that space. But I think what's interesting in that one is restaurants have realized that's a part of their business, right? That's not just, we also do that. So the need to have quality is greater than ever. So, for us, it was really I think an opportunity to gain market share over maybe some other substrates where polypropylene is a better offering. So an acceleration of trends and also putting some spotlights on things that are taking place. But I mean, you can look at, there's more e-commerce, there's more takeout food. I mean, there's healthcare applications here as well. I mean, it is, hit the fast forward button, and hopefully you were thinking about those long-term trends previously. That's probably the takeaway I have.
And maybe to jump in and underscore, there's a lot of talk around sustainability, and that's obviously something that has been accelerated by the pandemic. I think there are other developments around that. We've got an administration that, whether you like it or not, is more focused on sustainability than we have been historically. My personal view is a little different than maybe the conventional wisdom. I think it's not only on trend to be focused on sustainability as a big CPG or healthcare company, et cetera, but it's becoming a bigger part of the customer's decision-making process. I mean, you look at Method and 7th Generation and other consumer products that many of us probably purchase. If you were told that it's an extra penny or dime to buy that product because the package was made of post-consumer recycled product, many people probably would do it. All that said, I think there are sufficient barriers to sustainability getting implemented in a really big way. And so, you don't have the infrastructure with MRFs. You have multi-layer films that are still, a far better solution and far cheaper solution than single layer films, or use a lot less resin than rigid packaging, et cetera. So I think sustainability is getting a degree of emphasis and focus that it never has before. And I think, many CPGs and others are making these bold statements that by 2025, we will do X. But literally, not that I was not listening to Mike's comments, but I got an email 3 minutes ago, and one of the many you get all the time saying there's a customer who wants to transition to a curbside recycling option for plastic wrap products. And we each see those every single week. I'm not sure about every day, but every single week. And so I just think it's going to take time for the technology and the cost structure and frankly, some of the infrastructure to catch up. But I think we'd be foolish to say anything other than sustainability has taken a few steps forward in the last 12 months. And I think we'll continue to move at a faster pace than it has over the last 5 or 7 years.
That's a great segue. Thanks, Eric, to the question here for Suj, which again deals very specifically with sustainability. And Tekni-Plex, in fact, has some very nice exposure to sustainable substrates. So Suj, when you take a look at bolt-ons, how do you value a business's exposure to sustainability, sustainable substrates or attractive end markets where you see high demand for sustainable packaging? What do you see as the challenges, opportunities over the next few years in terms of deal activity, specifically as relates to sustainability?
Yeah, look, agree. It's a perfect segue from, Mike and Eric's comments, and actually, really dovetails right into the discussion. I couldn't agree more with their comments. Look, sustainability top of mind, for everybody. It has kind of gone from exactly what, Mike Palm said early on in terms of, a couple pages in the deck to, really a lot more emphasis. And so we are absolutely mindful of it. But, here's the thing. I would say, there's also, the risk, of putting too much emphasis on sustainability as well. And so the way we think about it, when taking a look at an acquisition is that it can't be on the basis of sustainability alone. It can't, we're not going to look at an acquisition on the basis of we need that particular substrate, right? It's got to be a sustainability plus kind of culture within the organization that, the target that we're looking at. So, and some of the guys hit on it. Sustainability as it relates to consumer buying behavior, sustainability as it relates to, even pre-COVID, these trends were already kind of emerging, what consumer buying behaviors were emerging, how folks are traveling, the e-commerce channel, choices that consumers have in the brands, and all of that, is creating an environment to change. And it's, while sustainability is an aspect of it, and it is clearly changing consumer behavior. When we take a look at a target, there's a big difference in the target in terms of, they can put a lot of pages into a deck and say, hey, we're sustainable. But if there isn't a cultural mindset inside that business that they're actually, focused on the consumer trends in connection with their sustainability, then, that's a lot of smoke and mirrors, So I think what we're focused on and, what we continue to look for and value in targets is really that combination, that mindset. Is the target able to connect those dots between the consumer trends and the sustainability trends? And, and candidly, Tekni, we are trying to do that here internally. We're connecting those dots for our customers to deliver those solutions. So when I take a look at a target, I'm looking for the same type of mindset. So, look, it's going to continue to gain momentum in terms of this conversation and in terms of value, but can't be viewed in a vacuum or isolation.
Thilo, if I could jump in there just to give a sort of anecdotal observation, but from being around and working on some situations where, like the guys said, I mean, no matter what you're involved in, sustainability is going to be going to be part of the conversation. Certainly if it's something that's resin based, you get to an 80-20 rule of where it becomes the focus, rightly or wrongly, of diligence discussions. And it's sort of interesting to observe, particularly within the private equity world, the different approaches that different people take. And I think some people candidly are one end of the spectrum of being, just very, very concerned and sort of somewhat all consumed in some instances with these issues. And I think others are take a view of where are they relative to competitors. And so maybe some of the infrastructure that you need doesn't exist today, but it's important to be ahead of those around you, ahead of those you're competing with in terms of providing the recyclability, compostability type features. But it is very interesting to observe, how many different people come at it from, many different perspectives. And there's, it seems there's a lot of just overall confusion. And there's obviously a lot of different competing voices in the world writ large. So it's been very interesting. And I think for some, it's almost less a question of sort of how are you going to do the next 3 to 5 years in terms of your projection model, but it's investment committees and folks that have a hard time getting their mind around what's my exit multiple look like. It's more of an exit multiple question than it is a near-term performance question. And those are hard things to they're hard things to answer given there's the level of uncertainty out there.
Well, I think
I think in a lot of those, it's what Eric said. It's what's the alternative, right? Like, that's where you have to do your work and be thoughtful about it, right? Plastics is for a lot of people a 4-letter word, but in a lot of cases, it's the right application and can't be replaced, and it's the most cost effective and does have, in a lot of cases, better environmental attributes than the alternatives, and it's just visible. And it gets a spotlight on it. So, I mean, that's our job. I'll give Thilo his plug. We've used him specifically kind of in everything we've touched in this space. And it's not how much is this company going to grow, but what are the alternatives for this thing that people are not really excited about or concerned about? And let's focus on that, kind of flip it upside down. But, it's what's the alternative in a lot of these cases versus just running for the hills because, it's plastic.
On that vein, when you're looking at, right, when we talk about sustainability, you could be talking about recycled content or recyclable, biodegradable, reusable, right? Many different types of packaging product that fall under the moniker of sustainability. How do all of you think about the pros and cons of each of those? I mean, there's a ton of uncertainty, Colin, as you just pointed out, but as you think about an exit multiple, do any one of those different categories seem more attractive than another, or one can't really say? And again, you're looking at some of the items, Suj, that you were talking about earlier.
Yeah, maybe just to give my view. So Colin nailed it in terms of it is an exit multiple, much less than an EBITDA question, and that's how we talk about it internally. I don't necessarily think that recyclable versus post-consumer resin versus some other option is necessarily better or worse. Of course, if you have the killer material that is, again, compostable or, let's just call it great, not only in terms of recyclability, waste, trash, but also in terms of carbon footprint, which most people don't talk about when they talk about plastics because it is so efficient. But I'm not sure that's the right dimension upon which to think about it. I think the right way to think about it is how well positioned is my business? So Mike owns a business that operates in the thermoforming space, which has tremendous on-trend recyclable characteristics around their PET offering. There are other players in that space who have a lot of trapped assets around polystyrene or other products. So you have to think about how much might I need to recapitalize my asset base, and then how well positioned am I relative to other people? And I think a lot of it gets back to, sometimes if I have a legacy product that ultimately is going to face pressure, and maybe bits and pieces of pressure over a long period of time, But it starts to be a jump ball, and your edge in that market, whether it's your cost position, your innovation, or just your relationship with that customer, that's really where you start to see the growth leakage come. And we've seen it in styrofoam as an example. And so it's not like it happens overnight, but I think ultimately Mike said it well up front, Mike Palm, that, people are enamored with the stability of packaging, but they're also enamored with those companies that have significant growth. And I think what you're going to find is that those parties that ultimately have more vulnerability because of sustainability, just chipping away at their growth, that's where you're going to see the impact on valuation.
Well, look, just to add on to that, most people know we have pretty good exposure, to polystyrene, and I think Eric's point is, it's spot on. There's going to be pressures, but there's also very solid reasons that, some of these substrates exist. And, yes, we have to be mindful. Yes, we have to be, kind of forward looking and forward thinking in terms of where the trends are, where the pressures are, but, it's not a strategy to be so reactive per se to things like legislation, yet it is a strategy to say, okay, how can I deliver the solution, to my customer that the customer needs, that the consumer needs, and kind of working with those trends and bringing sustainability along kind of for the ride, right? And so, polystyrene, there's a reason, and we're the largest United States domestic egg carton producer in the world, have experienced excellent growth, in that business, and it's there's a reason. It's an excellent business. So, yes, mindful of all the pressures, but not a strategy does it make, in a vacuum.
But it's a good example, Suj. I mean, I've told Suj for many years that there's no business I'd like to own in my personal account more than their egg business. But the performance attributes of that business relative to the alternatives are, far exceed what the other options are. And so, at the end of the day, the moat around the business, the economics that go into that, it's relatively undeniable given that business's performance.
Well, I've got an L.E.K study on polystyrene egg cartons gathering dust in my office. It's got a couple of my tears in my eye because we weren't able to get there. But yeah.
Flip it over, Mike. Flip it
over. Excellent. No, that market has become very well structured over time. But anyway, good. Let's continue. Eric, a question directed to you relates to just the supply and demand of packaging assets. While a number of packaging assets have tapped public markets, most assets are staying within privately held markets. There is increasing interest that we're seeing, right, from family-run offices and overseas wealth funds. And as Mike Palm said, SPACs are suddenly the hot topic of the day. So a lot of demand, a lot of increasing interest in the packaging space from financial investors of various flavors. So fundamentally, the question is, how do you characterize the supply and demand for packaging assets in the privately held markets? What impact does this have on how you think about where to place bets? Do you see private equity moving down the lower middle market because it's so active in the upper market size range? What do you see as the impact on supply and demand?
It's a really good question, and I think there are a couple different elements. First off, packaging has gotten a lot more attention from many more people, irrespective of what asset class they fit in. So I think on the demand side, there's much more of a knowledgeable base of debt investors, public market investors, private equity investors, sovereign wealth funds, and you go down the list. So private equity is just an example of that, where when I first started looking at packaging in 2013, I was probably one of them, I'll make up a number, but 24 private equity investors in our size range that have real interest. And now the number is so much bigger, I just probably will start crying. But in either case, the demand side has grown significantly. I would tell you on the public market side, my personal view, you've seen public markets shrink, and you've seen them shrink because 25 years ago, there were too many public companies that didn't really have a need or a fit with public investors' objectives, right? So public investors generally like real scale, and they like real predictability, and they like growth. So there are some public companies like a WestRock or other big ones where it makes sense for them to be public. And then I would say outside of a big consolidator like that, you're generally going to see higher growth companies. And so when we hear about the SPAC alternative, I view that as kind of an IPO light or just another variant off an IPO. And I don't think that's going to have a significant impact on the packaging market. Not that there haven't been SPAC deals that are less growth oriented, but I don't think it's going to be nearly as impactful as it will be in technology and healthcare, just to pick a couple of other end markets. In terms of family offices, sovereign wealth funds, and we haven't really talked about it, people have alluded to it, continuation funds, which are single purpose vehicles raised with limited partners, as opposed to a blind pool for a general partner multi-asset portfolio. This is a single asset for a single deal. So there are a whole series of different buckets of capital. And I think that's just leading to a better matching of assets with buyers. And so when you look at sovereign wealth funds or family offices, some of them are really focused on stability and on medium-term or even long-term time horizons. And for some deals, that actually takes away some of the friction by having a 10 or 15 or 20-year hold. It actually may take away some of the friction or risk when a normal private equity playbook is either I buy it at a really attractive price, which is really hard to do today, or I fundamentally grow the business and make it meaningfully better. And some businesses are just tremendous industry structure. It's going to be a slow and steady race. And so maybe the longer term holders are a better home for those businesses. So I would say those are some of the supply characteristics. On the some of the demand characteristics. On the supply side, I continue to be nervous yet comforted as time goes on. So I think packaging is a market that just, it's natural kind of creative destruction. There are these segments where entrepreneurs build businesses. They have really good capabilities. There are winners and losers in those spaces. You have thoughtful consolidators like Suj's business or like some of the businesses that Mike or I have invested behind. And they get bigger, and in most cases they get a lot better. And so that then opens up the opportunity for mid-size or large-size companies who have a different set of capabilities, ability to serve customers, et cetera. And then that creative destruction continues anew. So I think that the supply of private equity backed businesses, of private businesses that will ultimately become private equity backed. There's been a lot of consolidation, but I think over the medium term, you're not going to see a dramatic change in that supply and demand.
Awesome. Colin, is that what you also agree? You don't see any issues on the supply side? What do you see from the banking perspective?
No. I mean, it's pretty remarkable. Mike has tracked the sector for quite a long time, and it's pretty amazing the number of companies that through innovation and otherwise are go from I remember when Tekni was a $40-50 million EBITDA company, and next thing you know, it's a 200 plus. I think one of the other interesting things, not to go off on a tangent, but and Tekni's a good example, but is a lot of these companies that have grown up over the past 5 to 10 years get into an EBITDA size range that that it starts to exceed 200, 250, 300 million of EBITDA. The world of sort of private equity and pools of capital has gotten bigger, and so the ability to sell a company of that size is better today than it was 5 years ago, and it'll be better 5 years from now than it is today. But you're starting to sort of push the question of, do some of these companies, you're going to see, new companies go public. Does that become the most viable alternative at some point for some of these companies that have had great success in both organic growth and in consolidating. And I suspect, sort of 5 years from now, you're going to probably see a few entrants into that, public arena. So just an interesting observation. That said, there's a lot of people that can do big deals as well these days in the private market, or put together groups that can do big deals.
There's a nice lift to the artificial supply too, when Colin and Mike are convinced that everybody sell their companies every 2.5 years versus every 7 years. So we've tripled the amount of supply, luckily. Only other thing I would add was, there was a time where if you successfully took something from the lower middle market to the upper middle market, you were going to get 2 turns of EBITDA. And I think you're seeing values across the quantum now being pretty full. So that's kind of one dynamic that I think and that's the amount of capital in the middle market chasing platforms, and the pay up for platform kind of mentality, because the buy and builds have worked. So you used to get that plus the multiple arbitrage at the end. That's one thing to keep your mind on. Colin's comments about more and more, those upper middle market folks are continuing to move up and up. That does kind of maybe help that continue on, but it's an interesting dynamic to watch for sure.
Yeah. Excellent. Well, let's continue a little bit on that buy and build question. Eric, this is for you. Clients think about, aggressively thinking about new sources of growth for their businesses, right? As you obviously do as well. You think about adjacent product categories, new end markets, new substrates, or building share within existing categories that you're in. When you think about your portfolio companies, Eric, what kind of guidance do you give your companies in and around growth investment, and what do you think are the attractive sources of growth? Is it by end market? Is it by substrate? How do you think about what are those vectors of how you think about growth and where you get real value for the growth?
Yeah, so some of this is process and some of this is our propensity to invest in certain kinds of opportunities. So others are going to have a slightly different view. But we're very focused on, simply put, making our companies better. So we're very focused on outlining a strategy in partnership with management that becomes the North Star. And that strategy, by making our companies bigger, one of the phrases I've trademarked, or at least I should, is, we don't create Frankenstein. We're not trying to make a company bigger just to put more EBITDA together, which sometimes happens as you try to consolidate a market. We try to figure out, what do we want to become in 5 or 10 years? How do we stretch the thinking? And then how do we think about organic and inorganic growth to, as best as we can? You have to vary from strategy from time to time slightly, or you would have too narrow a focus. But how do we build and support that? So in all of our companies, we do that exercise of creating the North Star. I would say secondarily, we refine the value proposition. So specifically, where do we have a right to win? And then when you understand where you have a right to win, you can then cross-reference that. And in some companies, you're only a rigid packaging business. In others, you're only a label business. But they're oftentimes capabilities, maybe not substrates, where you can broaden or deepen your right to win. And so what we try to do is line that up. And this is an area where another plug for Thilo's team. We did this at one of our companies, Comar, which was, the whole strategy was to move the pie chart more towards medical and then move it more up market. And so what you want to do is marry the markets that are attractive with those that fit your capabilities. And so that process is one that we kind of go through time and time and time again. Maybe sort of a different example from our portfolio is PPC, where we backed an executive, Kevin Keneally. We started with the end in mind. We thought there was an opportunity in flexibles where the mid-sized players just didn't exist anymore due to consolidation. And we were going to create a purpose-built company with all the right end markets and capabilities. And so we had a pretty clear fuzzy vision, more so than a specific vision, because we had to react to what opportunities presented themselves in the marketplace. But we were able to then execute and check off many of the vectors of growth that you just articulated. And in doing so, not just growing for the sake of growing, but growing 3 times the industry growth rate on an organic basis. So for us, it's all about process, starting with the end in mind. But a lot of it is kind of know thyself. We're growth investors. We're builders of businesses, but also know thy company, if you will, where you understand how they fit, where they fit, and you can really put a strategy together that mirrors the opportunities, but also mirrors where you're likely to get the greatest impact.
Great, thank you, Eric.
That was really, perfectly said. I mean, we are not white paper. We have to be in this substrate or bust. This is, we should spend our time knowing all the dynamics in different end markets, in healthcare, in food, et cetera. What substrates are in the mix there? Where are the winners, losers? But that is, a knowledge base to then evaluate opportunities. We own Transcendia, Transrep when we bought it. A third of that business was going into window envelopes that were declining market, book jackets, with the, read on your device trend. But, we did 5 acquisitions and, they were in healthcare. They were in kind of differentiated, higher, higher product characteristic type businesses. And, that was the exact same thing. We did not have a white paper that said we wanted to be in window envelopes or that we wanted to be in book jackets, right? That was, the market does not like this field because of this. Can we look at this and take it somewhere that enhances the business? So it's a better company at the end of the day than when we started. So I think you have to have that kind of toolbox of understanding of packaging. But, if you're like, I'm deciding I'm going to buy the best XYZ when it comes out, be ready to pay a big price because there's probably 10 other people who are, or at least 10 other people that have the same XYZ. So that's the fun part.
Yep. Awesome. Well, this next question dovetails, I think, very much continues from this conversation. And Suj, this is directed at you. I think, as we all know, in many different categories of the packaging market remains still very, very fragmented. I think this goes to what you were saying earlier, Eric. You can remain very optimistic that there will continue to be a good flow of opportunities in this space because of the fragmentation. But there have been a number of consolidation plays, right? Over the past couple of years, we've seen consolidation plays in labels, in films, in flexible packaging, as Eric has talked about, thermoforming. You've seen it in a whole variety of different categories. And of course, you want to avoid creating a Frankenstein, to use Eric's. You're gonna have to drop in the nickel, Suj, if you use that term. But Suj, how do you think about the importance of and the benefits of scale in a marketplace that is generally so fragmented? Are there benefits to scale? What are those benefits?
Yeah, look, I mean, I think, I'll use our case as a good example, as kind of a tee-off point here. I mean, so we strategically, and going back years now, had kind of focused around one of our core competencies around, cap seals, for example, right? And we consciously went after kind of consolidating smaller players, at least in the North American market around our tri-seal business specifically. So when you think about scale and you think about kind of what that did over the course of time, I think, not only, was it powerful for us, but it was also a powerful value proposition to the customer. And I think that was key on multiple levels. One, you have, we were able to provide a global platform, to our CPG based customers, right? I mean, all of us on the phone and all of our portfolio companies, et cetera, have all heard, you want to, the big CPGs want less suppliers. Right. And you continue to hear less suppliers, I mean, this decades old kind of, discussion that's been going on, but it's going to be a constant. And so I think the key is providing value to the consumer, to the customer by virtue of scale, a global platform, being able to, to service them better, and candidly, at the end of the day, innovation, to the extent that, look, it's the core of M&A. We put together 2 organizations, 3 organizations for the benefit of the greater good. At least we want to believe that. But, that really is, it has to have tangential benefits at the end of the day, that flow all the way through. And, so I think to answer the question kind of briefly, scale is important. There's the counter argument that, the last thing that the world needs is a larger packaging company, right? But I think, scale can be really, really powerful if executed in the right way. What do you guys think?
Colin, Mike, Eric, any thoughts on the scale? Yeah.
No, I agree. I agree with Suj. I think different markets probably, are a little bit different. I think if you may be in a fragmented market, but have a, really differentiated, whatever the case, material science capability where, organic growth or, putting greenfield or brownfield expansion, could be more attractive than being a consolidator. So I think it's a little bit, end market dependent, but certainly, there have been some very successful consolidation stories, public and private, that have created a lot of value. It seems to often start with purchasing synergies as as the easiest and quickest advantage to consolidation. Obviously industry structure and improving the sort of market behaviors. But I think done well, scale can be very attractive.
Yeah. Yep. And certainly in some of those categories like polystyrene, boy, again, that category has become extremely well structured over time, and certainly and depending on who the end customer is, there can be those benefits to scale, no question, in that particular category. Well, that's great. Mike, a question for you. We've talked quite a bit about that healthy innovation. I think Eric talked about again that creative destruction that we see in the packaging sector. Question for you specifically is the innovation that you see within packaging leads to mix shifts, right? We see mix shifts in substrate. We see product mix shifts, rigid and flexible as an example. We see sustainability driving mix shifts by substrate. These can provide opportunities for investors to not just play the market cycle, right? I can make bets in these shifts. Can you talk to a couple of areas where you see some of these opportunities for mix shifts going forward?
Yeah, I mean, I think you have to start by taking a step back, and there's so many different end markets we could talk about. There's so many different answers within all of those. That's usually where we're focused when we're making an investment and kind of what's next and what's coming. So again, back to Thilo, the work we did with you when we invested in Anchor Packaging, we actually had you do, you figured it out, but we started by having you do blinded work because we didn't want to bias you on tell us why rigid thermoforming polypropylene is the best, answer. But we wanted you to go 5, 10, 15 years out. We wanted to look at, chemical recycling. We wanted to look at kind of what is out there, what could happen. And that's, so that was, the entire emphasis around that project. And I do think, you're going to have a group that is going to talk about innovation that actually knows about it versus, I play one on TV. So, that's going to be a more stimulating conversation. But I would tell you, when you talk about the different things happening kind of in the future on a polymer basis. And when you think about the different things from, truly recycling back to, virgin-like materials down the road, I mean, that's where it's going to be, what's going to be the infrastructure play in our country and what are we going to do from a recycling standpoint? And that, we're behind on that front, both from a total capacity and probably being thoughtful around it. So, that would be an area I think that flips a lot of this conversation on its head, especially when you talk about, plastics and, long-term viability. So that, that's a little bit of the silver bullet that's out there. I mean, anyone who spent time around the protective packaging space, as we talked about before, I mean, there's a big push from Amazon on minimizing that, delivery footprint of, what is it entailed. You're going to see consumer product companies making packages that are pretty much ready to ship, versus ready for the shelf, or they're going to have two alternative forms. So these are all the things, it's kind of hard to answer in kind of one specific example. Another one that's like, micro innovation, but anchor packaging, we have some great tamper evident products that are in the grocery store, and, that matters, right? People want to make sure you haven't had things touched, and taking a big step back on the sustainability thing. I meant to mention this before, like, we spent a lot of time on the food side. We're so focused on the substrate discussion. And I think sometimes we miss the bigger conversation around, just the whole food waste discussion, food safety and food waste. I mean, that I think the packaging industry is better at the chemistry sometimes than the marketing, right? And they got to get kind of out in front of, we're saving a lot of food, and, that food can be helped to feed people in need, et cetera. So, have to be thoughtful about sustainability of those substrates and have to continue to innovate and, use less, use more recycled content, all those things taking place. But I think there's also a greater kind of theme around keeping food safe and, keeping it for longer that gets lost here. That was like my politician answer. I didn't answer anything you asked, but I just took it on a couple different tangents. So
we have 10 minutes left. Mike wanted to make sure you got that out there.
Yeah, exactly.
Yeah. We'll let that one fly. Okay, that's good. Colin, let me ask you a question. We've talked a bit about the fragmentation in the market, but we also talked about market structure here a moment ago. Market structure in a category can often have a material impact on the profitability of the business. What are some sectors where you're seeing an improvement in the market structure? And has there been an improvement in the profitability of businesses in that particular sector?
It's a little bit of a dangerous question, Thilo, given the implication. The unsaid implication is, where pricing might be improving. I think, I'm gonna take it a slightly different way. I'd say one of the, just sort of observing over a long period of time, you have seen certain sectors, beverage can comes to mind that, that was talked about in the opening, and, you've got a relatively well consolidated, market there between, Ball, Crown, Arda. And I think it's been a benefit. That said, there's a very tough set of customers in and around that sector that, there's a good balance there, I would say. So I think it's been helpful in a space like that, but it's not as though, you've got all the leverage despite being a relatively consolidated market. I think profitability has improved for a number of, packaging sectors. And part of that is consolidation. Part of that is, the synergies from that. I tend to think, just sort of gut feel, that less so, that there's been sort of huge pricing benefits in some of these spaces, but it's, a lot of times it's companies are operated in a better way than they were, years ago. And you think of something like, Sean Fallman and team at Altium, or Kevin Kolinsky at Fort Dearborn, that have kind of taken companies that maybe had, longstanding, packaging folks that were, running the plants and have kind of taken a new way of doing things. And so, brought in plant managers that, come from, automotive or other manufacturing verticals that, maybe have a different mentality than sort of legacy, the way things were operated. And so I think you've seen a lot of just fundamental improvement in the efficiency of, businesses, individual businesses that have been, been really constructive, really helpful from a margin perspective, and then, often put those companies in position to then turn external and become, consolidators in a given space. So, market structure is certainly important. A company like Mauser, right, that has just tremendous, market structure, market share in a number of its markets, has been, extremely successful and, and making a lot of money for a lot of people over time. So there's absolutely benefits to, to great market structure, but there's a lot of other ways I think that, people have found to, to really improve profitability and, and growth, and put themselves in a better position over, over a period of time.
Great. Thank you, Colin. Well, I know we're running close to the end of the panel. We've got just a couple more minutes here, and I wanted to be able to open it up to some questions from the audience. And I've got one here from the audience that I'd like to pose to the full panel. There have been some recent funds with an explicit mandate on sustainability. How well does the packaging sector fit into a sustainability mandate relative to other non-packaging sectors, right? Many of those funds don't necessarily need to be focusing just on packaging to fulfill their mandate on sustainability. But the question fundamentally is, how well do you believe that packaging fits into that? And what kind of impact does that have given this new set of investors potentially coming into packaging world? Any thoughts on that?
I'll go real quickly. I mean, you compare this market to, energy, production, fossil fuels, et cetera. It's clearly a very different, end of the market. That said, it's taking the energy example, we're not solar, wind, et cetera. So I think it's a critical part of the food value chain, and as a result, while it's not protected, it's certainly not. While it's not fundamentally going to get eviscerated, if you will, it's also not fully protected, and so it does require continued innovation and, frankly, continued change by society. To the extent sustainability goals remain a key priority. So I would, again, just my view, I would put it somewhere in the middle. And I think your degree of risk is really company specific or substrate specific, more so than, writ large for the whole packaging market.
I was going to mention earlier when we were talking about the importance of sustainability for customers, employees. I mean, hiring millennials, they care about this stuff, but no more so than any institutional investor. So there's sustainable funds focused on that, but the mandates that we are receiving and that are important to our investors, they're the same ones that public companies are facing, and there is no fad here whatsoever. There is no short-term. So, the question of how this one fits in, it's interesting. We've had discussions about this because right now where ESG stands today, there's no real standard. It's pretty nebulous, right? So it's kind of this vague thing that's important. I think right now people are just trying to get better. We've always thought, we've been around for a long time. We're doing the right things as stakeholders and taking care of employees and doing fundamentally positive things, but we've never tracked them before. So we're hiring in-house ESG folks for the Jordan company to help us monitor our portfolio. So right now it's so nebulous that I think part of it is, making sure that wherever you're starting, kind of what Eric is saying, we're trying to make our companies better. And I think this is an area that we're trying to make our companies better. So I don't, the way I see the lens in the world today is there is very good ESG stories in packaging. And you can, where did you start and where did you finish is a big part of this. And what did you track and how did you help things? And I'll take it a step further. We've seen recently, and talk about marketing, there's been a couple packaging deals that have actually flipped this whole thing, reverse them and turned a, I won't say too specific, but turned a plastic packaging story into, a recycling story, and they're getting the benefits. So this is, there is going to be this kind of continued how you market who you are component of this. And I say there's no standards. It'd be kind of hard to, because, you're trying to apply this to so many different areas, right? Like, you're not going to have the same standard on a catheter that you're going to have on, a straw, right? So, it's pretty fascinating what's happening. But this stuff, if you have European investors or California investors, or, keep adding onto the list, like it's real.
Well, that's great. Well, very much of it, we're at time here. This has been a very, very informative panel. Very much appreciate Mike Palm. Thank you so much for the keynote. Suj, Mike, Colin, Eric, very much appreciate the thoughts today. And hopefully everybody can make it also then to the next couple of conferences. Again, the next one is this coming Thursday, April 29th, with a very specific focus on sustainability from brand owner perspectives. Hope you can make the next couple of conferences as well. Thanks again to all of today's panelists and to our keynote on M&A and packaging. Thank you all very much.
Thanks, Thilo. Thanks for having us.
Everybody.